Welcome to the Deep Dive, the show where we cut through the noise, sift through the sources, and, well, try to extract the most important nuggets of knowledge to get you truly well informed. Today we're tackling a topic that's it's pretty much everywhere you look, the seemingly unstoppable rise of AI. The headlines scream about an AI supercycle painting this picture of endless innovation, exponential growth, just an uninterrupted boom. But what if that popular story isn't really the whole story? What if the foundations of this, exponential growth are actually, well, surprisingly fragile? Today we're doing a deep dive into something often overlooked when we talk about AI's explosive trajectory, the risks. Specifically, the risks to its underlying infrastructure. We've got our hands on a really comprehensive analysis that doesn't just question, but directly challenges this notion of a smooth, uninterrupted ride. It suggests there are some pretty significant speed bumps, maybe even roadblocks ahead for AI infrastructure investment. So why should you care about the nitty-gritty of AI infrastructure risks?
Well, look, this isn't just about what's happening with tech stocks or some abstract financial forecasts. It's really about understanding the foundational elements that will ultimately determine the future of AI's integration, into our society, our economy, even our daily lives. Getting a clear, more nuanced picture beyond the hype is, I think, absolutely crucial for making informed decisions, whether you're a business leader, an investor, or, frankly, just someone trying to grasp this rapidly evolving technological landscape. So what are these hidden vulnerabilities, the ones threatening to slow down or maybe even derail the AI infrastructure boom? We're going to unpack a complex confluence of factors, everything from tightening economic pressures and the very real physical limits of technology to emerging regulations, shifts in market dynamics, and looming capital constraints. And here's the kicker. The analysis suggests that a significant growth shock for AI infrastructure isn't just possible, but highly probable, maybe within the next 24 to 36 months. So yeah, let's dig in.
It really is fascinating how pervasive that narrative is, isn't it? This idea of the unstoppable AI supercycle. It's taken hold everywhere. And look, the report doesn't deny AI adoption itself. That's undeniable. It's transformative tech. It's here to stay. However, its central argument isn't about AI's ultimate potential, but specifically about the rate of infrastructure spending growth. It suggests that this exponential rate we're seeing right now, it's actually quite fragile.
Fragile, not unstoppable. That's quite a different framing, isn't it? A significant shift. So this growth shock prediction, within 2 to 3 years, what exactly are the key triggers the report points to? It sounds like it's not just one thing, but maybe a perfect storm brewing.
That's exactly right. The analysis highlights this powerful confluence of factors. First, you're looking at tightening macroeconomic conditions globally. We're talking about an environment where money isn't as cheap, not as plentiful as it was. Second, there are these inherent physical and economic limits to how much we can just keep scaling this technology. It's not an infinite upward curve. There are real-world constraints. And third, new regulatory frameworks are starting to emerge globally, and these will inevitably add friction, introduce costs, and frankly, reshape the market in ways many aren't fully anticipating yet.
And AI infrastructure is just inherently capital intensive, right?
Yeah.
We're talking massive upfront investments, projects with incredibly long duration before they might see significant returns. That sounds like a recipe for extreme vulnerability when capital costs start climbing.
Oh, it absolutely is. The report really emphasizes that. Its capital-intensive, long-duration nature makes it acutely sensitive, that's the term they use, acutely sensitive to rising capital costs and economic downturns. I mean, think about it. When money becomes significantly more expensive to borrow, projects needing billions up front for a return that might be 5, 7, even 10 years out, well, they suddenly look far less attractive. Their risk-adjusted returns just might not be there anymore.
And we've definitely seen this movie before, haven't we? The report draws parallels to historical precedents.
Yeah.
It feels familiar.
Yeah, there's a very, very clear historical pattern here. During the recessions of 2001, tied to the dot-com bust, 2008, the global financial crisis, and even 2020, the initial shock of COVID-19, we consistently saw deep, immediate cuts to hardware-centric IT capital expenditures, CapEx, right? When companies tighten their belts, those big-ticket hardware investments, the kind of AI infrastructure demands, they're typically the very first things on the chopping block. And AI, being so intensely hardware-dependent right now, is particularly exposed to this historical playbook. It's sort of baked into the model.
Okay, what about the physical side of things? We're talking about, the actual silicon chips, the massive data centers themselves, and of course, energy. Are there specific vulnerabilities in the physical supply chain or, inherent technological constraints that could act as critical points of failure beyond just the economic shifts?
Definitely. Yeah, the report identifies critical points of failure in the physical supply chain that are Well, they're almost existential threats. Think about the overwhelming concentration of leading-edge semiconductor fabrication in Taiwan, specifically at TSMC. It's staggering. Or the increasingly constrained availability of grid power in key data center markets globally. These aren't just minor hiccups, they're systemic vulnerabilities. And then on the technology side, the very scaling laws that have driven AI's progress, they're now showing clear signs of diminishing returns. It's getting harder. Plus, there's this fascinating concept called algorithmic efficiency, which, while generally positive for AI's capabilities, can paradoxically decommoditize raw compute power, potentially impacting the hardware providers who are, thriving right now.
Okay, wait. So on one hand, algorithmic efficiency sounds fantastic, right? Faster, cheaper AI. Everyone wants that. But the report calls it a double-edged risk, well, especially for the hardware companies. How can making AI more efficient actually become a threat to the very companies supplying the infrastructure? That sounds counterintuitive.
It is, but it's a really important paradox to get your head around. Think of it this way. If I invent a car engine that's suddenly, say, 10 times more fuel efficient, people might buy more cars, drive more, which sounds good for car makers maybe. But the demand for raw gasoline per mile driven would plummet, right?
Right. Okay.
In AI, if algorithms become so smart, so efficient that they can achieve the same results with, I don't know, a tenth of the computing power, then suddenly the need for that raw brute force GPU power, those really high-end chips from companies like NVIDIA, it starts to diminish for a given task. The value shifts. It moves away from just having the most powerful hardware to having the smartest software, the most efficient algorithms. That's what's meant by decommoditizing raw compute power. The pure horsepower becomes less of a premium feature. It potentially erodes the competitive moat of those hardware leaders and could squeeze their margins in the long run.
So if the broader market isn't perhaps fully aware of these multifaceted risks, the economic, the physical, the technological, the efficiency paradox, what does that mean for the current valuations we're seeing in the AI sector? Are we maybe in a bit of a bubble here, perhaps underpricing some significant downside?
Well, the report's primary conclusion is exactly that. It argues that current market valuations simply do not adequately reflect the probability or the severity of a significant spending growth deceleration. Essentially, the market seems to be pricing in a near perfect, uninterrupted continuation of exponential growth. It leaves very little room for error, very little room for the kind of multi-factor risks we're discussing. And this isn't just, an abstract financial analysis for the pros. It's really about understanding the underlying fundamental forces that shape a critical sector of the global economy, and ultimately how reliably AI will integrate into our lives. It suggests there might be a potential disconnect between the, let's say, euphoria of market expectations and the ground realities of actually building out this incredibly complex infrastructure.
Okay, that definitely sets the stage. Let's really unpack those economic disruption scenarios now, because that's where the rubber truly hits the road, right?
Mm-hmm.
You mentioned AI infrastructure projects require these massive upfront investments, long durations, makes them highly sensitive to the cost of money. That sounds like a huge deal, especially when interest rates are already up and might stay higher for longer, as they say.
Oh, it's a monumental shift, yeah. Remember the era of the RRP zero interest rate policy? It dominated for so long after the 2008 financial crisis. Money was, essentially free to borrow. That made these long-duration, capital-intensive projects incredibly attractive, super appealing. Now, we're firmly in a higher-for-longer paradigm, right? Rates are significantly elevated, and this fundamentally changes the whole calculus for project viability. When the cost of borrowing billions of dollars to build a new data center today goes up significantly, the net present value, the NPV, of those far-off future cash flows from that data center drops a lot. It just makes the project much less appealing from a financial standpoint.
And what's the direct impact of that for the companies actually building this infrastructure? How does that translate from, abstract economic policy to their balance sheets and their plans?
Well, rising rates directly increase borrowing costs for any company with high capex needs. It's simple math. This inevitably forces them to decelerate their expansion plans. They just can't afford to build as much as fast. It also reduces their future growth prospects naturally, and critically, it compresses their valuations. Why? Because those future earnings are discounted more heavily back to today's dollars when rates are higher. The report actually references some time series analyses showing a significant negative impact from Fed rate hikes on even major tech companies like Microsoft. So it underscores this direct, tangible link. It's not just theory.
So it's not just theoretical. We're actually seeing this play out in the real world already. Companies are pulling back.
We absolutely are, yeah. There's a Q3 2023 survey of chief financial officers, CFOs, by the Richmond Fed that's quite telling. It found that around 40% of firms had already curtailed their capital and non-capital spending plans specifically because of interest rates. And that was up notably from about 30% in Q4 2022. This data suggests a lagged effect, meaning the full impact of monetary tightening might still be unfolding, and it will likely continue to act as a significant drag on corporate investment moving forward. It takes time for these effects to ripple through.
And what about data center REITs? For our listeners, those are the real estate investment trusts that essentially own and operate these massive data center properties. They seem like cornerstones of this whole infrastructure boom. How are they uniquely vulnerable to rising rates?
Yeah, data center REITs are particularly exposed. Their whole business model, their profitability, relies heavily on the spread between the yields they generate from leasing their properties and their own cost of capital, what they pay to borrow money or raise equity. When interest rates rise, their cost of debt directly increases, squeezing that vital spread. That's one hit. Furthermore, as rates climb, lower risk fixed income assets, think government bonds, they become far more attractive to institutional investors. This can potentially divert capital away from REITs, making it harder and more expensive for them to raise the necessary funds for new developments or acquisitions. So it hits them on both sides.
This sounds like it brings us to this concept you mentioned, a viability threshold. What exactly does that mean for data center construction specifically? Is there like a tipping point?
Yeah, this is where a detailed break-even analysis becomes really critical for understanding the risk. We can break down the total cost of ownership, or TCO, for a typical data center. Roughly speaking, land accounts for maybe 15% of the capex, power and cooling infrastructure about 25%, and then the IT hardware itself, those expensive GPUs, servers a massive 60% of the initial capital expenditure. Then you have OPEX, the ongoing operational expenditures, which are heavily influenced by the facility's energy efficiency, measured by something called power usage effectiveness, or PUE. Now, the report's analysis suggests a very precise critical threshold. It finds that a sustained 200 to 300 basis point increase in the weighted average cost of capital at the WACC above current levels would render many new build projects NPV negative.
Wow, okay, that's a very specific threshold. 200 to 300 basis point increase in WACC and NPV negative. For our listeners who might not, track these financial metrics daily, could you quickly demystify WACC and what NPV negative really means for these massive projects? It sounds like it just means they'd stop making financial sense, like full stop.
Yeah. Absolutely. Yeah, let's break that down. Think of WACC, the weighted average cost of capital, as basically the average interest rate a company pays to finance everything it does, its operations, its new projects. It considers both the debt it takes on and the equity it raises. It's their overall cost of doing business and expanding. Now, when that cost goes up by, say, 200 basis points, which is just 2 percentage points, right? Borrowing money for those multi-billion-dollar data centers becomes much, much more expensive.
Okay.
An NPV negative, or negative net present value. That means when you project all the future income a data center might generate from leasing space over its lifetime, and then you discount that future income back to today's dollars using that higher WACC. It actually looks like the project will lose money. It just wouldn't be a financially sound investment anymore unless, they could suddenly charge significantly more for their services or find ways to build them a lot cheaper, which is also hard.
And when you connect that specific threshold, that 2 to 3 percentage point increase in WACC, to the nearly $7 trillion in projected data center capital outlays needed globally by 2030, that becomes a truly massive headwind. It could really slow the entire build-out down, couldn't it?
It certainly could, yeah. That kind of increase makes a huge portion of future projects potentially financially unviable without some radical changes in pricing or construction costs. It's a major hurdle. Now, let's maybe pivot to recession impact modeling, because historical data gives us a very clear playbook here. Corporate IT budgets contract, and they cut deeply, consistently in specific areas.
Yes, I remember the dot-com bust, the global financial crisis, COVID-19, hardware, and more speculative projects always seem first on the chopping block. It feels like a consistent pattern.
Exactly. The report details how, during past downturns, hardware and speculative projects are indeed cut first and deepest. Meanwhile, mission-critical software and services, the things needed to keep the lights on, are often preserved, viewed as essential for maintaining core operations. What makes a potential AI infrastructure downturn potentially far worse, however, is what the report calls a double whammy.
A double whammy.
Yeah.
That sounds unpleasant, like trying to build a new house during a downturn, but also the price of lumber just keeps skyrocketing. Is it that kind of squeeze?
That's a great analogy. Yes, it is precisely that kind of brutal squeeze. It's a demand-side shock from a recession. Companies are tightening their belts, cutting spending, combined with a supply-side shock from persistent inflation in core inputs. So imagine that world. Companies are pulling back on investment, but at the same time, the cost of the high-end GPUs they need is soaring, maybe 70–90% over MSRP like we've seen, or energy prices are skyrocketing, or specialized labor costs are up. McKinsey projects a staggering $5.2 trillion in data center capex by 2030, with 60% of that being IT hardware. This dual pressure, the demand drop plus the cost increase, would likely lead to a much sharper and deeper contraction than historical precedents suggest.
Let's look at those historical numbers in the report's table 2 for a sec.
Yeah.
It really highlights how specific sectors within IT react to these downturns. It's not uniform.
No, it's not. And the data is stark. In 2009, during the depths of the GFC, computing hardware spending plummeted by a staggering 14.9%, almost 15% down. In stark contrast, enterprise software actually saw a marginal increase of 0.3%, tiny but positive. Fast forward to 2020, the initial COVID shock. Overall IT spending contracted by 8%. Again, the largest drops were in devices and data center systems. The one notable exception, as you might expect, was public cloud services. They actually grew by 19% as companies scrambled to shift to remote work.
That's a crucial distinction. It really demonstrates a clear shift towards flexible OpEx-based cloud consumption pay-as-you-go and away from large upfront on-premises CapEx investments during crises. So if a recession hits, how does that change the prioritization of AI use cases within enterprises? What kind of AI projects get the axe and which ones maybe survive?
A recession would dramatically shift enterprise AI project approval criteria. Those blue sky projects, the highly innovative experimental ones aimed at long-term strategic advantage or maybe finding breakthrough capabilities, they'd likely be postponed indefinitely. Too risky, too uncertain on payoff. The focus would pivot almost entirely to initiatives that can demonstrate clear, quantifiable, and importantly, short-term ROI. With a strong emphasis on immediate cost savings and operational efficiency, think automating back-office processes, optimizing supply chains, maybe improving customer service efficiency through chatbots. Those kinds of projects, the ones with clear payback, will likely survive budget cuts. And this inherently favors AI software and platforms that deliver that immediate value, rather than the raw infrastructure build-outs needed for more experimental, large-scale model training. It becomes about must-have versus nice-to-have.
And how does this public market sentiment, this potential downturn, then bleed into private AI infrastructure valuations? Because often private valuations take their cues from the public markets, don't they? There's a connection.
Absolutely. Yeah, a recession-induced correction in public markets inevitably spills over into private valuations. It's a well-established linkage. Private firms' valuations often rely heavily on public comparables, looking at similar public companies and their trading multiples. When those public multiples compress, meaning companies trade at lower prices relative to their earnings or revenue, the anchor for private valuations gets significantly lowered. This makes it much harder for venture-backed startups to raise subsequent funding rounds at higher valuations. It leads to an increase in painful down rounds where a company raises money at a lower valuation than its previous round. And unfortunately, it can lead to potential failures if funding dries up completely. The report notes that the current median enterprise value to revenue multiple for AI startups, around 29.7x, well, that's seen as particularly vulnerable to compression in a risk-off environment. It's pricing in a lot of optimism.
So it's not just the big public companies feeling the pinch, but the entire private ecosystem too, from the earliest stage startups right up to those maybe eyeing an IPO. Now let's talk about inflation and geopolitical supply chain disruption. The report highlights extreme concentration in this area. This sounds precarious.
Yes, the physical supply chain for AI is extremely concentrated geographically, and that makes it incredibly vulnerable to both inflation and geopolitical events. It's a huge risk factor. The fabrication of leading-edge semiconductors, the absolute heart of AI accelerators like GPUs, is overwhelmingly concentrated in Taiwan, specifically at TSMC. This concentration, combined with persistent inflation in component costs and significant energy volatility, creates what can only be described as systemic risk. And the report argues quite strongly, actually, that the market appears to be underpricing this Taiwan-related disruption risk.
Underpricing it? How so? Are investors just not seeing this as a significant probability, or are they maybe underestimating the sheer scale of the impact if something did happen?
Well, the report explicitly states that current valuations for key semiconductor companies seem to imply massive, uninterrupted growth year after year after year. Just smooth sailing. This suggests the market is either assigning a very, very low probability to a disruptive event involving Taiwan, or it's simply failing to price in the true magnitude of such a supply shock. A proper valuation model, the report argues, really should incorporate a significant non-zero probability of a supply chain disruption here, given the obvious geopolitical tensions. Ignoring it seems optimistic.
And what would a major disruption involving Taiwan mean for the global AI ecosystem? Is it really as catastrophic as some suggest, like lights out?
The report pulls no punches here. It really doesn't. A military conflict, a blockade, or any other major disruption involving Taiwan would effectively halt the production of virtually all high-end GPUs, paralyzing the entire global AI ecosystem. That's a direct quote. The report calls it a catastrophic, near-extinction level event for the current AI hardware ecosystem. Strong words. And while efforts like the U.S. CHIPS Act are underway to try and diversify manufacturing and new fabs are being built elsewhere, meaningful production capacity from those efforts won't realistically be available until the late 2020s, maybe even early 2030s. That's, a decade away. It simply doesn't mitigate the near to medium-term risk concentration we see today.
Wow. Okay. Beyond that potential catastrophic event, there's also the ongoing issue of just GPU cost inflation, right?
Yeah.
Even without a major geopolitical incident, prices have been high.
Indeed. Yeah, we're seeing persistent, significant price premiums. High-end NVIDIA GPUs like the RTX 5090 and RTX 4090 were reportedly trading at premiums of 89% and 73% over their manufacturer's suggested retail price as of early 2025. That's huge. And while the long-term trend for computational performance per dollar has historically been downward, things get cheaper over time. Short-term inflation in the absolute hardware costs directly impacts the ROI, the return on investment of new data center projects. It simply means your initial investment buys you less compute power, stretching out the time it takes to become profitable.
And data centers are, as we know, famously hungry for energy. What about energy cost volatility is another major risk factor? Powering these things isn't cheap.
No, it's not. Data centers are truly voracious consumers of energy. That's the term used. Global electricity demand from data centers is projected to more than double by 2030. Double. Reaching a level equivalent to the entire current consumption of Japan. Think about that. In the U.S. specifically, data centers are expected to consume up to 12% of the nation's total electricity by 2028. That's a massive chunk. This represents huge, relatively inelastic demand, which exposes operators to significant energy price volatility and increasingly severe grid constraints in popular locations. Rising energy costs directly increase operational expenditures, the OpEx, compressing margins, and it could ultimately lead to higher electricity bills for all consumers in affected regions as data centers compete for scarce power resources.
So we've discussed economic headwinds, supply chain fragility, energy costs, and the limits of traditional scaling. Now let's pivot to technology itself. The investment thesis for exponential growth in AI infrastructure often assumes that scaling is all you need, right? That's simply throwing more compute, more data, building bigger models will always lead to better and better performance. Is that actually holding true? Is that still the case?
Well, that core assumption is actually facing some significant challenges now. The report highlights a phenomenon called subscaling. Recent academic research, particularly from 2025, indicates that the predictable performance gains we used to see from simply scaling up models are beginning to decelerate, especially in large language models. This is attributed to factors like, the declining quality and increasing redundancy of available training data. We might be running out of high-quality text and data from the internet. We're reaching a point where simply adding more lower-quality data yields only marginal improvements, which kind of undermines the economic justification for just endlessly exponential infrastructure growth. It's like digging for gold, right? At first you find big nuggets easily, but eventually you're sifting through tons and tons of dirt just for tiny flakes. The effort versus reward changes.
So it's almost like Moore's law for semiconductors, which we know has also slowed down over the last decade or so as physical limits are met. The AI hardware boom could be following a similar S-curve trajectory. But what does that really feel like for someone trying to build the next big AI model? Are they just pouring more and more money, more resources into these systems for smaller and smaller gains in performance? Is that the reality now?
Precisely. That's a good way to put it. Moore's law drove exponential progress for decades, but has notably slowed since around 2010 due to the physical limits of miniaturization. It got harder and more expensive. The report suggests the AI hardware boom could follow a very similar S-curve, transitioning from that steep exponential growth phase to increasingly incremental gains as it encounters its own physical and economic constraints. And for developers, yes, it absolutely feels like diminishing returns. You're spending huge amounts of resources training on massive data sets with colossal GPU clusters for weeks or months just to get a slightly better performing model, maybe a few percentage points on a benchmark. This leads to a new theoretical framework the report introduces, the race to efficiency.
A race to efficiency. That sounds like a fundamental shift in how AI progress is defined, moving away from just raw scale.
It really is. This framework posits that sustained AI progress is no longer just about raw compute power, about bigger models and more GPUs. Instead, it critically depends on the rate of efficiency gains. That means innovations in algorithms, in software optimization, in hardware architecture design. These efficiency gains need to offset those diminishing returns from just brute force scaling. Without that continuous innovation and efficiency, achieving the next truly breakthrough level of AI performance could demand, millennia of training or unrealistically large GPU fleets, as the report puts it, which is obviously economically and physically infeasible. So this fundamentally shifts the value proposition. It moves from simply buying more compute to developing smarter, more efficient ways of using that compute.
And what about energy consumption as a hard ceiling here? I mean, if these models just keep getting bigger, even with some efficiency gains, surely there's a physical limit to the power they can draw from the grid.
Yeah, energy consumption is indeed a primary physical constraint. It's a hard wall. While specialized AI accelerators like GPUs are incredibly energy efficient for the specific math they do, the total demand for compute across the entire AI landscape is just growing even faster than those efficiency gains. And cooling alone, just keeping these massive systems from overheating, accounts for a substantial portion of a data center's energy budget, sometimes 30–40%. At some point, the marginal cost of the energy required to train or run a slightly more powerful model will simply exceed the marginal benefit that model provides. That creates an economic ceiling, making further scaling uneconomical, regardless of how much hardware you could theoretically throw at the problem. You just can't afford the power bill.
Now, let's talk about algorithmic efficiency breakthroughs again. On one hand, they could unlock new capabilities, expand the market, which sounds good for everyone, but on the other, the report calls it that double-edged risk. How so? You touched on it earlier with the car analogy of the fuel efficiency, but let's dive a bit deeper into the economic debate around this.
Yeah, this is a fascinating and really crucial paradox. While algorithmic advances can certainly expand the overall market for AI, making it more accessible, more powerful for new applications, they can also drastically reduce the amount of compute required for a given level of performance. And this directly threatens to essentially destroy demand for existing and planned hardware infrastructure. Less compute needed per task means potentially less hardware sold. We're already seeing tangible examples of this happening right now.
Like those architectural innovations, such as mixture of experts or MOE, how does that impact the demand for raw compute?
Exactly. Mixture of experts is a prime example. This architectural innovation allows for extremely large models, but for any given task, only a fraction of the model's parameters, the experts, are actually activated and used. This significantly cuts the computational cost during inference, running the model without sacrificing much performance. DeepSeek's models are a leading illustration of this approach. Then you have techniques like model compression and quantization. These reduce the model size and the precision of its calculations, again, often without significant accuracy loss. This can lead to maybe a 4x size reduction and a 2–4x speedup, which means you need much less powerful hardware to run it, or you can do much more with the hardware you already have.
So the economic debate here seems to boil down to, does needing less compute mean total spending falls because, well, you just don't need as many GPUs? Or does it trigger something like the Jevons paradox, where increased efficiency actually leads to more overall usage and maybe even more spending?
This is a key point of contention, and honestly, it's not straightforward. The conventional view, the simple view, is that if you need less compute per task, total spending on hardware falls, fewer GPUs needed. However, the Jevons paradox, which historically observes that increased efficiency in resource use can actually lead to increased total consumption of that resource, suggests something different. It suggests that increased algorithmic efficiency lowers the effective price of intelligence. This could accelerate AI adoption so dramatically across totally new use cases and industries that it actually leads to a net increase in total compute spending, more people using AI in more ways.
Okay, but there's a nuance there for the hardware providers, right? Even if total spending goes up.
Exactly. Here's the nuance, especially for hardware providers like NVIDIA. Even with potentially increased overall spending, this fundamental shift decommoditizes raw compute power. The value proposition moves away from just pure horsepower, raw teraflops, towards intelligent, efficient usage. Smart algorithms matter more. This potentially erodes the competitive moat of the hardware leaders. It could lead to margin pressure for incumbents because the market is no longer just buying raw capacity, they're buying smart efficiency, which the hardware companies might not fully capture the value of. The value shifts up the stack, maybe to software and algorithms.
And this efficiency also enables the rise of edge computing, right? Where AI processing moves away from the giant cloud data centers and closer to the data source directly onto devices. That seems like a direct challenge to the central cloud model.
Precisely. Yeah, smaller, more efficient models are a key enabler for the widespread adoption of edge computing. It unlocks it. This means AI processing happens locally on devices like smartphones, autonomous vehicles, industrial sensors, smart cameras. The drivers are clear. Lower latency, faster response times, enhanced data privacy, because sensitive data doesn't necessarily have to leave the device, and reduced bandwidth costs by not sending absolutely everything up to the cloud for processing. Enterprise adoption of edge AI is already becoming widespread, with projections hitting hundreds of billions, like $378 billion by 2028. Now, while it won't entirely eliminate the need for large, centralized data centers for things like training, it will certainly shift significant inference workloads, the running of AI models, away from the centralized cloud, tempering their exponential growth rate.
And looking even further out, the report mentions alternative computing paradigms. This sounds, I don't know, a bit like science fiction sometimes, but it represents a potential long-term risk to the current GPU-centric, von Neumann architecture that underpins so much of today's AI infrastructure.
Yeah, these are definitely not immediate threats for next quarter's earnings, but they represent fundamental potential disruptions that could redefine compute entirely down the road. First, you have neuromorphic computing. These are brain-inspired chips designed for extreme energy efficiency. They're starting to emerge commercially around now, 2025, mostly for low-power edge applications. Widespread adoption, though, probably still a decade or more away. Then you have quantum computing. It holds immense theoretical promise for tackling currently intractable AI problems like complex optimization or material science simulation, far beyond what even today's supercomputers can handle. But timelines, they vary wildly. Google might say 5 years, NVIDIA's CEO predicts maybe 20 years or more. The mainstream consensus for tackling truly significant practical problems is probably closer to 2035, 2040.
Right.
Still very early days. And interestingly, even analog computing, which is actually an older paradigm, is seeing a resurgence. Why? Because of its potential for high information density and remarkable energy efficiency for specific AI tasks like matrix multiplications, which are absolutely fundamental to how neural networks work. Startups are actively developing analog chips targeting edge AI applications right now. So while these aren't poised to dethrone GPUs next year, they represent the cutting edge of innovation. They could fundamentally reshape the demand for today's AI infrastructure in the long run, and certainly something investors need to keep on their radar screen.
Okay, let's shift gears now to something often maybe overlooked in the pure tech conversation, regulatory and policy risks. It feels like governments around the world are just starting to really wrap their heads around AI, and intervention here can be a powerful brake on growth, can it?
Oh, it absolutely can, yeah. Regulatory intervention fundamentally imposes costs. It constrains supply. It reshapes markets. It's a powerful force. The report highlights how global fragmentation in regulatory approaches, the US, the EU, China, all pursuing very different paths, is creating an incredibly complex landscape. And this complexity might inadvertently favor the large incumbents, like the hyperscalers, Google, Microsoft, Amazon, who have the vast resources, the legal teams, the lobbyists, to navigate multiple divergent legal and technical requirements. Meanwhile, smaller players, startups, they could really struggle.
Starting with AI safety regulations specifically, what new burdens are being introduced? Because it sounds like this isn't just about making AI nice or ethical, but imposing real, tangible costs on development and deployment.
Yeah, these impending regulations introduce significant compliance burdens, they add friction to the development process, and they create new legal liabilities. It's not just guidelines, they effectively function as a kind of tax on AI development, increasing the cost and time it takes to bring new models and applications to market. In the U.S., for example, proposed state laws like New York's RAISE Act and California's SB 1047 target developers spending over, say, $100 million on a single AI training run. They require rigorous safety testing, documentation, safeguards. That's a heavy lift. Federally, the Commerce Department's Bureau of Industry and Security, BIS, has already imposed export controls on high-performance AI chips, restricting access for countries of concern, mainly China, and creating a kind of strategic bottleneck.
And the EU AI Act seems to be the most comprehensive, maybe the most prescriptive globally. What are the estimated compliance costs looking like there, especially for smaller players, SMEs?
Yeah, the EU AI Act is definitely positioned as the world's most comprehensive risk-based framework for AI. It's very detailed, and the compliance costs look substantial. They're not trivial by any means. One analysis estimates the act could cost the entire European economy something like 31 billion over 5 years, potentially reducing AI investment by nearly 20% in the region. That's a big hit. For a small to medium-sized enterprise, an SME, deploying what the Act deems a high-risk AI system, the cost could be up to 400,000 euro, which, for a business with maybe 10 million turnover, could reduce profits by a dramatic 40%. That's potentially existential for some. For large corporations, the costs are expected to be comparable to, or maybe even exceed, the millions they spent becoming compliant with GDPR, the data privacy regulation. Now, while some argue the costs are negligible for the giant labs developing the foundational general-purpose AI models, that argument overlooks the much broader cumulative costs imposed on the thousands of companies deploying these models across diverse industries. The burden falls widely.
So this creates what the report calls a compliance moat. It really sounds like the large tech companies with vast resources would actually benefit from this regulatory complexity, while startups and maybe open source AI efforts would really struggle to keep up. Is that the dynamic?
That's precisely the compliance mode concept, yes. Divergent global rules mean a single AI model cannot simply be deployed universally without costly localization efforts, specific compliance checks, potentially different training data for each jurisdiction. This inherently benefits large incumbents like Microsoft and Google. They have the legal teams, the engineering resources, the financial muscle to manage this complexity across dozens of different markets. It raises the barrier significantly for startups, who often struggle with capital and lack those internal resources. And it severely stifles the open source AI ecosystem, which typically lacks a central corporate entity to manage global compliance obligations. It's a real impediment to innovation outside of those few very large players.
Okay, what about antitrust and market structure? The AI industry is, let's face it, heavily concentrated in the hand of just a few tech giants. This must be a major concern for regulators looking at competition.
Oh, it's certainly drawing intense scrutiny. Absolutely. This concentration with a handful of large tech companies controlling not just the compute resources, but also the vast data sets needed for training, the top talent, and the key distribution channels, it raises significant antitrust concerns. Regulators are worried about things like potential algorithmic price fixing or self-preferencing, where a company's AI services unfairly benefit its own other offerings over competitors, or market consolidation via aggressive acquisitions. Big tech has been, by far, the most active acquirer of AI startups over the past decade. Now, a significant antitrust action, like a forced breakup of one of these integrated tech giants, that would have profound and, frankly, largely unpredictable consequences. It could fragment integrated cloud platforms, maybe opening the market to more competition, but it could also disrupt the massive coordinated capital investment and long-term research currently undertaken by these large firms, which might paradoxically slow down overall innovation in the short to medium term. It's complex.
And finally, under policy risks, a very tangible physical risk, energy and environmental constraints. The report says the primary constraint on AI infrastructure growth may not actually be silicon or capital, but simply watts. That's a really powerful image.
It is, and it's becoming a critical physical threat. The power demands of modern AI data centers are truly immense. A single hyperscale data center can easily consume as much power as a small city. Grids in key data center hubs, think Northern Virginia, Arizona, Texas, Dublin, Singapore, are already at or nearing capacity. The interconnection queues for getting new large power hookups can stretch for years. This power choke point is rapidly becoming the single greatest physical bottleneck to new data center construction and expansion in many critical regions. You can have all the money and all the chips in the world, but if you physically can't plug it in, you can't build it.
And the carbon footprint of these data centers is also growing rapidly, which inevitably brings in environmental regulations and scrutiny.
Exactly. Data centers already account for about 1% of global energy-related greenhouse gas emissions, and that figure is projected to grow rapidly as AI scales. This growing footprint draws significant scrutiny from environmental groups, policymakers, and even investors focused on ESG. The imposition of things like carbon pricing, stricter emissions caps, or mandates for using renewable energy will directly increase data center operational costs. It makes the power potentially more expensive or harder to source reliably. This makes securing reliable, affordable, and increasingly clean power a critical differentiator for competitive advantage. The winners here will likely be data center REITs and operators who have foresightedly locked in pre-existing large-scale power agreements, or pioneers of on-site generation like exploring small modular nuclear reactors, SMRs, or those strategically building in more remote locations where there's surplus, often renewable, power available. This also makes energy infrastructure companies, utility companies, or providers of advanced power generation technology potential interesting contrarian investments in the AI boom.
That's a huge point that often gets overlooked in the pure AI hype. Okay, now let's explore market saturation and potential demand destruction. The current massive infrastructure build-out assumes widespread, rapid, and critically profitable AI adoption across the board. But what if that doesn't materialize quite as expected, or maybe it's just slower than the hype suggests?
Yeah, this is where the demand-side risk truly emerges, and it's a major concern flagged by the report. There's a significant risk of what's often called pilot purgatory. This is where a large number of AI proof-of-concept projects, despite initial excitement and investment, simply fail to translate into full-scale production deployments that deliver tangible, quantifiable business value. They just stall out.
Pilot purgatory. I love that term. It sounds like so many corporate initiatives over the years, honestly, not just in AI. Companies get excited, they greenlight a proof of concept, maybe spend 6 months on it, but then it just sits there. Or it gets quietly scrapped. Is that what we're seeing? Lots of money being spent on experiments that never actually deliver real value at scale?
Exactly. And the data paints a pretty sobering picture here. While Gartner might estimate AI agents in enterprises will grow from, say, 1% to 33% by 2028, which sounds fantastic on paper, the actual failure rate of these projects is reported as alarmingly high. Some studies report a staggering 98% of enterprise AI initiatives fail to reach production or meet their stated objectives. 80 to 98%. A 2025 S&P Global Market Intelligence survey found 42% of companies had abandoned most of their AI initiatives, which was way up from 17% just the year before in 2024. The average organization, it found, scraps about 46% of its AI proofs of concept. That's nearly half of their experiments essentially going nowhere productive.
So it's not primarily a tech problem then, like the AI isn't good enough. It sounds more like an organizational or strategic challenge.
Often, yes, that seems to be the consensus. The primary reasons for failure aren't typically that the technology itself doesn't work. It's more often organizational and strategic hurdles. Things like a lack of clear business objectives defined from the outset, poor data quality or data access issues, difficulties integrating the AI with existing legacy systems, and crucially, a lack of cross-functional buy-in from different departments who need to use or support the AI. This means a significant portion of the current AI infrastructure spending is essentially supporting corporate experimentation, exploration, learning, rather than proven, value-creating applications already driving revenue or cutting costs significantly. And as the initial hype inevitably wanes, CFOs will demand clear, tangible ROI. An IBM report, for instance, found enterprise-wide AI initiatives achieved a pretty meager 5.9% ROI on average. If that value isn't delivered consistently and convincingly, it could trigger mass cancellations of initiative, leading to a sharp drop in demand for the underlying infrastructure and leaving a lot of very expensive compute capacity underutilized.
Okay, what about consumer AI then? We've seen this explosive user adoption with things like ChatGPT. Does that translate into a broad willingness for consumers to actually pay for these services? Or is there a similar monetization gap there too?
That's the crucial monetization gap the report highlights on the consumer side as well. Yes, while ChatGPT and similar generative AI models have driven incredibly rapid user adoption globally, we're talking 61% of American adults using AI in the past 6 months, maybe 1.7 to 1.8 billion global users. This broad usage has not really translated into broad willingness to pay for premium features. Not yet, anyway. A March 2025 survey found a striking 71% of Americans would not pay extra for AI assistant features and products they use. Only a tiny 8% said they'd be willing to pay more. And currently, only a small fraction, maybe 9% of Americans actually pay for AI tools like ChatGPT Pro or similar premium subscriptions. It's a sliver of the total user base.
So that Apple Intelligence survey that got a lot of headlines, where supposedly 80% of Apple users said they'd pay for enhanced AI features on their devices. That sounds like it might be a real outlier, doesn't it? Specific to Apple's ecosystem, maybe.
It very much appears to be, yes. That Apple data showing over half of their users willing to pay more than $10 a month for Apple Intelligence, it could well be a unique outlier. Why? Maybe due to deeply ingrained brand loyalty, the seamless integration within the Apple ecosystem people expect, and maybe the perceived value of privacy and convenience Apple emphasizes. It contrasts sharply with the broader market sentiment seen in other surveys. So the risk here is that the market, looking at that Apple number, may be significantly overestimating the size and profitability of the direct-to-consumer AI subscription market overall. If the primary business model for most consumer AI ends up being ad-supported or bundled into existing subscriptions at little extra cost, then the revenue per user will be much lower, which means that massive infrastructure being built to support potentially billions of users might end up being significantly undermonetized, leading to lower than expected returns for the infrastructure providers funding it.
So the ultimate driver of infrastructure demand is really the success of the applications it supports. And if those projects are failing at high rates, both in the enterprise and potentially facing challenges in consumer willingness to pay, that's a direct and significant threat to sustained demand growth for all that hardware.
Absolutely. And the paradox is that investment continues to pour into AI infrastructure, even as these failure rates remain high or even rise. It seems largely driven by FOMO, the fear of missing out. No one wants to be left behind in the AI race, but this leads to what the report calls a significant misallocation of capital. Infrastructure is being built at a furious pace, assuming demand that might not fully materialize, or certainly not as profitably as hoped, for AI applications, many of which may never achieve commercial viability or deliver the anticipated ROI. Leading indicators to watch here would be industries maybe with complex regulatory requirements like healthcare or finance, seeing high project failure rates, or maybe industries already struggling with ROI, like some creative fields. If they see particularly high attrition rates in AI projects, that could signal a broader slowdown on the horizon.
That makes a lot of sense. Okay, let's move now to competitive dynamics and the potential for margin compression. It sounds like the high growth and, frankly, the very attractive margins we're currently seeing in parts of the AI infrastructure stack are quite vulnerable to disruptive competitive forces.
They are, definitely. A fundamental challenge comes from the commoditization risk posed by open source models. High-performance open source AI models are rapidly closing the performance gap with proprietary ones, models like those from OpenAI or Google. And crucially, they're often free or very low cost to deploy and modify. This fundamentally forces the big cloud service providers, the hyperscalers like AWS, Azure, Google Cloud, into a more commoditized role, whether they like it or not.
So instead of being able to sell their own high-margin and proprietary AI services or exclusively push their partner models, they're increasingly competing on who can offer the cheapest and most efficient platform to simply run these powerful open source models that anyone can download.
Precisely. It shifts the battleground towards pure infrastructure as a service, or IaaS, which is a segment historically characterized by intense price competition and inherently lower margins. It's about providing the best plumbing at the lowest cost. Microsoft Azure, for example, provides a fascinating case study here. While they heavily promote and benefit from OpenAI's proprietary models, they also defensively offer over 1,900 different models from various third-party and open-source providers on their platform. It's a defensive necessity, really, to attract customers who want choice and flexibility, but it directly pressures their margins on the AI services layer. You have the CSPs investing billions and billions in expensive cutting-edge hardware like NVIDIA GPUs, while the software layer, the actual AI models themselves, becomes increasingly open and commoditized. So they're paying a premium for their essential inputs, the hardware, but facing intense price pressure on their outputs, the platform services. That's a classic recipe for margin compression over time.
And this sounds like a familiar tech story too, boom and bust cycles. What about overcapacity scenarios and potential price wars, specifically in the data center market itself? Are we potentially headed for a glut of data center space?
Yeah, the report explicitly compares the current data center market dynamics to historical examples like the fiber optic glut of the early 2000s or the notoriously cyclical memory chip markets. The data center market is clearly entering a boom phase right now. Now, while Q1 2025 shows very low vacancy rates below 1% in major North American markets like Northern Virginia, which is incredibly tight and rental rates are up strongly, over 17% year over year in places like Chicago. There is a massive pipeline of new capacity currently breaking ground globally. JLL projects an astonishing 10 gigawatts of new data center capacity starting construction globally in 2025 alone. 10 gigawatts. Now, much of this is reportedly pre-leased, but the sheer scale of this build-out introduces significant overcapacity risk if demand falters even slightly.
So if demand growth slows down from that expected exponential curve to maybe just a strong linear growth, That massive pipeline could quickly lead to an empty hotel risk, as they say in real estate.
Exactly. The empty hotel risk is very real. If demand growth slows from its current exponential trajectory to merely linear, or if it decelerates further due to recession or project failures, the market could quickly flip from being critically undersupplied today to significantly oversupplied maybe 18-24 months from now. This scenario would likely trigger a classic price war among data center operators and REITs. Faced with vacant capacity and the high fixed costs from their massive investments, they would be forced to slash rental rates to try and fill space. This leads to a potentially dramatic collapse in revenues and margins. It could be particularly damaging for developers who finance their projects based on the assumption of continued high rental rates and near zero vacancy. We could see default or distressed assets emerge.
So ultimately, all of this hinges on whether the unprecedented amount of capital currently flowing into AI infrastructure can actually be sustained. What are the risks on the capital markets and funding side? It seems like this entire boom is just fueled by a truly huge amount of capital chasing AI.
Yeah, the sustainability of that funding is indeed a critical variable. The venture capital market, in particular, has become the absolute epicenter of AI investment. It's ground zero. In Q1 2025, a staggering 57.9% of all global VC dollars invested went into AML startups, and it was even higher in North America, 70.2%. That level of concentration is extreme. This creates systemic risk for the entire startup ecosystem. It becomes highly correlated and uniquely vulnerable to a sector-specific downturn. Imagine a major AI safety incident that shakes public trust, or a sudden regulatory crackdown, or even just a widespread perception that the technology has hit a plateau. Any of those could potentially freeze VC funding overnight, which could, in turn, lead to a mass extinction event for many startups that are reliant on that next funding round.
And the valuations themselves for many of these private AI startups are, let's say, extreme, what the report calls an AI premium.
They really are. Early-stage AI-enabled fintech companies, for instance, were commanding a median valuation 242% higher than their non-AI counterparts. Just slapping AI on it boosted the price tag. In Q1 2025, average revenue multiples for large language model vendor startups were reportedly 44.1x. Even Series A rounds were averaging an astonishing 39.0x revenue multiple. These are sky-high numbers. This creates a significant valuation overhang, meaning many companies have raised money at valuations that they will frankly struggle to grow into, especially if they face economic or technological headwinds we've discussed. There's also a large gap between the capital inflow, $104.3 billion raised by U.S. AI startups in just the first half of 2025, and the actual exits, like IPOs or acquisitions, which were only $36 billion in the same period. This means much of this invested capital is still unvalidated. It's purely on paper based on those high multiples. A downturn could leave VCs holding bags with large paper markups, but very few actual cash returns for their own investors, their limited partners.
And the public market sentiment for those key bellwether stocks, NVIDIA, AMD, ARM, Supermicro, even the data center REITs, they're at or near historic highs. They seem to be pricing in, well, a perfect future, don't they?
They absolutely are. These companies have become the bellwethers for the entire AI ecosystem, and their valuations act as a crucial anchor for the private market as well. As of mid-2025, NVIDIA was trading at a hefty 37x forward earnings, reflecting enormous growth expectations baked in. ARM Holdings was at 39x price to sales and an even loftier 79x forward PE, suggesting its stock price had significantly outpaced its near-term fundamentals. And the data center REITs. They had implied capitalization rates of just 4.4%, the lowest across all commercial real estate sectors, and enterprise value to EBITDA multiples exceeding 27x, extremely rich valuations across the board.
So the fundamental risk here is that these valuations effectively price in a perfect, uninterrupted continuation of exponential growth, leaving virtually no room for error, no margin of safety for any of the multitude of risks we've just spent the last while outlining today.
Exactly. That's the core concern around valuations. Any significant correction in these public bellwether stocks, whether triggered by an earnings miss, reduced guidance from the company itself, or just a broader market downturn, would likely have an immediate and severe cascading effect. It would transmit directly and rapidly to the private markets. You'd see down rounds become common, IPO windows slam shut, and the mergers and acquisitions market would likely freeze up as buyers and sellers struggle to agree on value. This would fundamentally reset the capital market assumptions that are underpinning the entire AI infrastructure build-out, forcing a potentially painful reevaluation of projects, investments, and strategies across the ecosystem.
Okay, this has been a lot about the risks and the potential problems, painting a very clear picture of the vulnerabilities. But how do we translate all this into actionable intelligence? The report talks about quantitative risk modeling and scenario analysis. What's that actually look like, taking all these complex interconnected factors into account?
Right, this is where we move beyond just identifying the risks to trying to quantify their potential impact and, importantly, preparing for them. The report outlines a clear framework using three primary scenarios: a base case, a bear case, and a crisis case. The base case essentially assumes a continuation of the current positive market trajectory. Think maybe 2-3% positive GDP growth globally, slow and gradual Fed rate cuts, perhaps beginning late 2025, and AI infrastructure spending continuing to grow at a robust 30-40% year-over-year clip, and crucially, no major geopolitical or technological disruptions. This serves as our baseline, the business-as-usual forecast for comparison.
Okay, and the bear case. What would typically trigger that scenario, and what would it look like for AI infrastructure spending growth? A slowdown, presumably.
Yeah, the bear case models a moderate but significant deceleration. This scenario would likely involve a mild global recession, maybe flat, slightly negative GDP growth for 2 or 3 consecutive quarters, and the Fed funds rate remaining stubbornly higher, say above 5% through 2026. Under this bear case scenario, the report projects AI infrastructure spending growth would be reduced by a significant amount, maybe 50% compared to the base case. So still growing, but much, much slower. What would trigger it? Likely persistent inflation, forcing central banks to maintain tight monetary policy for longer than currently anticipated, which then leads to a broader contraction in corporate IT budgets as companies pull back.
And then the crisis case. That sounds like the black swan event, the real worst case scenario we touched on earlier.
It is, yeah. The crisis case models a high severity but lower probability black swan type event. The primary trigger used in the report's modeling for this case is a significant geopolitical disruption in the Taiwan Strait that halts or severely curtails semiconductor production from TSMC. This would represent a catastrophic supply-side shock. The assumptions here include an absolute decline in AI infrastructure spending, not just reduced growth, but an actual contraction, a deep global recession triggered by the disruption, and a fundamental, painful repricing of virtually all technology-related assets globally.
Okay, so how would these various scenarios, base, bear, crisis, impact the different sectors within the AI ecosystem? It sounds like some would be hit much harder than others, given their specific exposures to these risks.
Oh, absolutely. The impact would absolutely not be uniform across the board. It depends on where you sit in the value chain. For semiconductors, companies like NVIDIA and AMD, they are obviously most exposed to the extreme crisis case, given their critical reliance on Taiwan for manufacturing. But they're also vulnerable to the risk of a technological plateau limiting demand, or that algorithmic efficiency trend decommoditizing their expensive hardware over time. The cloud providers like Azure, AWS, Google Cloud, they are highly sensitive to the bear case. Why? Because enterprise customers cutting back on cloud consumption during a recession hits their core business, and they also face that margin pressure from the rise of powerful open source models running on their platforms. What about data center REITs? Companies like Digital Realty or Equinix, they seem most vulnerable to the bear case as well, with higher interest rates directly increasing their cost of capital and hurting development. Plus, they face the risk of overcapacity leading to price wars, and they're directly impacted by those physical grid capacity limitations. And finally, AI software companies. They're exposed to the bear case through customers shifting focus to purely cost-cutting ROI projects and potential project cancellations. And in a severe crisis case, widespread enterprise failure or budget freezes would severely impact their customer base and growth prospects.
Let's look at Table 5 in the report, the scenario analysis summary. It projects potential 2-year total returns for these different sectors under each case, base, bear, crisis. What are we looking at for semiconductors, for example, across these scenarios? Seeing the numbers really brings the potential impact home.
Yeah, the numbers are stark. For semiconductors, in the base case, things go well. The model projects still healthy returns, maybe plus 25% to plus 40% total return over 2 years. But in the bear case, that drops sharply to negative territory, negative 20% to negative 35%. That reflects that deep enterprise capex freeze hitting hardware first. And in the crisis case, triggered by Taiwan, we're talking about a potentially devastating negative 60% to negative 80% total return. That's due to an almost total halt of leading-edge chip supply. It's, as I said, almost an extinction-level event for their current business model in the short term.
Wow. And for data center REITs, which we know are so sensitive to interest rates and capital costs, what do the scenarios suggest for them?
For data center REITs, the base case still projects decent positive returns, maybe in the plus 15% to plus 25% range over 2 years. But a bear case could see those returns plummet to negative 25% to negative 40%. That assumes the weighted average cost of capital increases by that 200 basis points we discussed, and maybe data center vacancy rates double due to slower demand. In a crisis case, it's even worse, potentially negative 50% to negative 65% returns, as tenant defaults rise and development pipelines grind to a halt because capital markets effectively freeze up. These numbers, even just directionally, truly show just how impactful these identified risks could be on different parts of the AI ecosystem. It's not just a minor fluctuation we're talking about in the bear crisis cases. These are potentially fundamental shifts in value.
Okay, so this has been an incredibly detailed look at the risks. How can someone listening, maybe an investor, a business leader, someone setting strategy, actually use this detailed intelligence to mitigate these risks and maybe even find opportunities in what could be a very turbulent period ahead? It's about being proactive, right? Not just reactive.
Exactly. This is where we shift from diagnosis to prescription to actionable strategies. First, the report strongly recommends establishing a proactive risk dashboard. This means continuously monitoring clear, specific, data-driven leading indicators that can act as triggers for reviewing portfolio allocations or strategic plans. For example, on the economic disruption front, monitor the 10-year U.S. Treasury yield. If it sustains above, say, 6.0%, that's a strong signal to significantly reduce exposure to interest rate-sensitive sectors like data center REITs. For recession risk, watch for 2 consecutive quarters of negative corporate IT spending growth reported in surveys from reliable sources like Gartner or Forrester. That would likely trigger a defensive shift away from hardware-centric semiconductors towards more resilient software or services. And for geopolitics, monitor a credible political risk index for the Taiwan Strait, like the one from Eurasia Group. If it crosses a predefined threshold indicating rising tensions, that should trigger the implementation of specific tail risk hedges.
What about technology indicators on this dashboard? What specific shifts should we be watching for to signal that maybe a tech plateau is happening or that disruptive efficiency is really taking hold?
Good question. For technology plateaus, a key indicator to watch would be the failure of, say, 2 consecutive major frontier model releases from the leading AI labs, like OpenAI, Google DeepMind, Anthropic, to show significant, widely acknowledged state-of-the-art improvements on key industry benchmarks for accuracy or capabilities. If progress stalls noticeably, that tells you the scaling laws might indeed be hitting a wall. For algorithmic efficiency, a major signal would be the release of a new open-source model that achieves performance very close to the leading proprietary model, let's say over 95% on key tasks, but does so using significantly less training compute, maybe less than 25% of the compute cost. That would signal a truly disruptive efficiency gain that could rapidly redefine hardware demand.
And finally, market and competitive indicators. What are the tangible signs that oversupply or margin compression are starting to bite in the market itself?
Okay, for market indicators, watch data center vacancy rates closely. A sharp increase of, say, 200 basis points, that's 2%, in average vacancy across the top 5 North American data center markets within a single quarter would be a strong warning sign of emerging oversupply. That means more empty data center space than expected, putting downward pressure on rental rates. And on public valuations, a significant drawdown, maybe 25% or more from the peak, in a key bellwether stock like NVIDIA, especially if it's not accompanied by a broader market crash, should be considered a sector-specific sentiment shift. That would trigger a comprehensive review of all private AI valuations that are often implicitly tied to that public market leader's performance.
Okay, so beyond just monitoring these indicators, what about actual hedging and mitigation strategies that investors or even companies involved in this space can employ right now to protect themselves?
Yeah, the report suggests several practical approaches. For instance, to hedge against that risk of algorithmic efficiency hurting specific hardware players, you could consider pairs trades. Maybe going long on semiconductor manufacturing equipment companies like ASML, Applied Materials, which benefit from the diversified global fab buildouts, while simultaneously going short on incumbent chip designers whose specific moats might be eroding from increased efficiency enabling competitors. To hedge against rising energy costs, potentially squeezing data center margins, taking long positions in natural gas futures or investing in renewable energy ETFs could provide a direct offset. For direct downside protection against a broad valuation correction in the AI sector, purchasing long-dated put options on some of the highest multiple AI stocks or on sector-specific ETFs is a classic hedging strategy, though it comes with its own costs and complexities. And of course, simple diversification is key. Increasing allocation to less correlated sectors or to more traditional defensive sectors of the economy is always a sound strategy during periods of heightened uncertainty like this.
So it sounds like a market dislocation, if one occurs, isn't just about risk and problems. It could also create significant opportunities for those who are prepared and maybe see beyond the immediate fear. What are some of these contrarian, defensive, and recovery plays the report highlights? Where might the smart money flow?
Absolutely. A market dislocation, while undoubtedly painful for many, almost always creates significant opportunities for savvy investors or well-positioned companies. For contrarian plays, think about that energy infrastructure bottleneck we discussed. As reliable power becomes the primary constraint for data centers, companies involved in power generation, transmission infrastructure, and grid modernization think established utilities with strong grid positions. Manufacturers of critical components like transformers or developers of next-generation power sources like SMRs or geothermal energy, these companies become critical enablers and could see increased investment and valuation. Also, a significant slowdown in speculative AI spending could see corporate IT budgets reallocate back towards more traditional, proven enterprise software, things like ERP systems, CRM, and especially cybersecurity. This could benefit established, profitable companies in those more mature tech sectors. For defensive positioning within the AI space itself, the focus should be on software companies that provide solutions with clear, immediate, and high ROI, specifically those focused on tangible cost-cutting and operational efficiency. These are the tools that are most likely to survive budget cuts during a recession because they deliver measurable value quickly. And in the private markets, the private credit space could become very attractive. As traditional venture capital equity funding potentially dries up or becomes much more expensive, private credit funds that can provide structured debt solutions to well-run but capital-starved AI companies will find themselves in a very strong negotiating position.
And then for recovery plays, thinking longer term, once the dust potentially settles and the market begins to normalize, where would you look then?
Yeah, after a significant correction, assuming the long-term promise of AI remains intact, the market leaders in the hardware space, those with the strongest balance sheets, the most defensible technological moats like potentially NVIDIA and TSMC, would likely be the best positioned assets for a recovery. The underlying demand for compute will eventually reassert itself. Additionally, a downturn will inevitably lead to failures among less capitalized or less viable startups. This creates an opportunity for well-funded companies and private equity firms. They'll have an unprecedented chance to acquire valuable technology, intellectual property, and top engineering talent at distressed prices from these failing or struggling ventures. This consolidation could position them strongly for the next growth cycle.
This has been incredibly insightful, really drilling down into the details. So just to recap the core insight here. While AI's long-term potential is undoubtedly clear and truly transformative, its current infrastructure boom faces substantial, maybe underpriced risks, economic, technological, regulatory, market-driven, that absolutely warrant a sober, clear-eyed assessment. It's not really about being a pessimist, is it? It's more about being a realist and maybe a prepared investor or business leader navigating this space.
That's precisely it, yeah. Understanding these nuanced, multi-layered risks empowers you, the listener, to navigate the AI landscape with far greater insight. Whether you're making critical business decisions, considering strategic investments, or frankly, just trying to make sense of the world's fastest evolving technology beyond the daily headlines. This isn't just about trying to predict a crash, it's really about understanding the underlying forces at play, the potential vulnerabilities, and the possible range of outcomes.
And the journey to being truly well-informed, as we always say, is an ongoing process, always looking beyond the headlines, digging into the deeper currents. And this deep dive has certainly given us, and hopefully you, a lot to chew on, a lot of nuance to consider. So here's maybe a provocative thought for you to mull over as we wrap up. If the AI supercycle does experience a significant growth shock, if that brute force approach to scaling hits a real wall due to these constraints, what unexpected areas of innovation or perhaps human endeavor might see a resurgence of focus and investment? Areas may be freed from the intense gravitational pull of just pure compute scaling. How might a smarter, maybe more efficient, perhaps even more human-centric approach to AI, born from these very constraints we've discussed, ultimately accelerate its most impactful and truly beneficial applications in the long run? Something to think about. We encourage you to keep exploring these ideas, to question assumptions, and to always look beyond the surface. Until next time, keep digging deeper.